Coming up on Market to Market, another series of deadly tornadoes devastate portions of the grain belt. Showers dampen planting prospects in Iowa and raise concerns over nutrient runoff. And we'll examine how small towns deep in the heart of oil country are weathering a downturn in prices. Those stories and market analysis with Naomi Bloom next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, May 15 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. With the annual rite of spring planting progressing steadily, commodity traders paused Friday to ponder the impact of a wet weekend across much of the Corn Belt. According to DTN, showers and thunderstorms will be prevalent in the Midwest through Sunday. But the dark clouds are not without silver linings. While planting will likely be delayed a few days, the rains will help recharge critically important subsoil moisture. Rain also is expected on the southern plains, benefiting early planted corn and sorghum. While farmers are cautiously optimistic that weather conditions will boost their productivity this year, people all over the grain belt hope Mother Nature will be less violent this weekend than last. The 9 to 5 kicked off this week with cleanup efforts in portions of the Midwest. Emergency responders searched through splintered wreckage in parts of Texas and Arkansas after a line of tornadoes battered several small communities, killing at least 5 people.
We got up and went straight to the bathroom, and as soon as we hunched down, you could feel the roof pulling off of the house.
There goes the school! There goes the school!
Further north, a cyclone tore through the Hawkeye State, ripping the roof off a high school in Lake City, Iowa. About 150 students, faculty, and family members that were present for awards sought refuge before the EF1 twister struck. Iowa Governor Terry Branstad said no one was hurt in the Calhoun County storm. And early this week, the town of over 1,700 dealt with the aftermath.
We went to the basement, and when we came back up, we had lots of trees down, a lot of debris.
The specter of severe weather hangs over a vast swath of the country every spring, and it's a gamble for farmers as to when to plant crops. Producers outside Lake City, in Calhoun County and other outlying areas, also find themselves entangled in another battle where the elements play a central role.
So much of this depends on Mother Nature and how much moisture we get. And I can promise you, our farm, our neighbors' farms, nobody wants that nitrate going down the river, down the Raccoon River to Des Moines. We want to keep that here to nourish crops.
Aye. Graham Gillette.
Aye.
Susan Huppert.
Aye.
Mark Wallace.
Aye. So that motion passes.
Late this winter in the state's capital city, the decision was made to file a federal lawsuit against the boards of supervisors in 3 counties upstream in northwest Iowa. At issue are 10 drainage districts, which the plaintiff, Des Moines Water Works, claims violate the Federal Clean Water Act by failing to obtain the proper permit to discharge nitrates from farm runoff into the North Raccoon River. The watershed provides clean water for over 500,000 central Iowans.
It's hard for me to believe that 88,000 farmers have the right to foul the water for the entire state of 3 million people. I just don't understand how that happens.
While naturally present in the soil, nitrogen also is added as fertilizer by farmers. And as the crucial nutrient breaks down into nitrate, it moves with water. Nitrates in drinking water have been attributed to health issues and infant fatalities. Des Moines Water Works has operated one of the largest nitrate removal facilities in the world as needed since the early 1990s. A costly venture, the system ran an unprecedented 97 days this winter with a price tag of well over $500,000. Nitrite levels spiked again this spring, forcing the aging facility into 24/7 operation again since April 17th.
Des Moines Water Works is going to be faced with an $80 to $180 million proposition to build a new denitrification plant. That's the ultimate tax on the people of Des Moines.
Much to the chagrin of the agricultural industry, the utility argues that massive artificial subsurface drainage infrastructure is a point source polluter and in violation of state and federal recommendations. While the case could have nationwide ramifications, some officials believe such accusations don't hold water.
I really think Des Moines Water Works is asking for things that contradicts the way that we have looked at the Clean Water Act. I also believe at the end of the day, if we're all about clean water, and I believe most folks on both sides of this issue are about clean water, that a non-regulatory approach is superior to a regulatory approach.
Some agricultural stewards have undertaken voluntary efforts to reduce runoff on their own dime for years. But Iowa adopted its own nutrient reduction strategy in 2013, and the science-based plan implemented a host of environmental efforts funded in part by the state of Iowa.
I think if people realized the efforts that we're making out here and the great strides that we're making in terms of conservation and nutrient management, I think people would change their tune a little bit.
Though expanded initiatives aim to dwindle away the problem, progress at the speed of nature is unacceptable to some downstream.
We realize that the best knowledge is those closest to the production, but they need to assume the responsibility for reducing environmental impacts downstream, and that's not happening under the current system.
Despite brewing litigation, seeds are still being sown in hopes of a strong environmental return on investment. But authors of Iowa's nutrient reduction strategy, like Dean Lemke, admit finding the right balance can be an uphill battle.
The problem is that those plants need that nitrogen at much higher concentrations in the root zone than the drinking water standard, maybe 40 parts per million in the root zone compared to a 10 part per million drinking water standard. So when the rains come in Iowa, these landscapes leak some of that nitrogen. In spite of farmers' good efforts to keep as much of that nitrogen there as they can, it leaks out.
U.S. shoppers kept their spending in check last month as modest wage growth continued to keep family budgets tight. After rising more than 1% in March, retail sales were unchanged in April. Over the past year, receipts have risen less than 1%. But the addition of more than 3 million jobs over the previous 12 months has done little to drive up worker income. Wages have risen just 2.2% over the past 12 months, barely outpacing inflation. And just in time for summer, gasoline prices are on the rise. AAA reports the average cost of gas nationwide is $2.69 per gallon. That's up 13% from last month, but it's still more than $1 below last year. Cheaper gasoline, of course, is due to sharply lower crude prices. While lower fuel costs are a positive development for drivers, they can be catastrophic in regions depending on a profitable petroleum industry. But some towns in the heart of oil country are diversifying their economies in an attempt to be less reliant on crude. Josh Bittner explains.
Last summer, the price of oil began a steep decline that lasted 7 months. By January, the cost of a barrel of crude oil dropped by 60% to just over $47. That decline undermined the boom in U.S. oil production and brought business to a crawl in some oil towns across the Great Plains. In some ways, the current market's behavior is mimicking the trend from 30 years ago when the cost of a barrel of oil plummeted 62% to nearly $9 per barrel in an 8-month period. Boom and bust cycles are anything but new in some parts of Texas and Oklahoma. And the oil industry, as well as local residents who depend on it, have developed innovative coping mechanisms to thrive when the price takes a dive.
Well, we're very fortunate that we have learned somewhat from our past. And of course, we never learn enough. But when you look at the early 80s when the oil dropped, we weren't heavy in the oil, but it affected us quite a bit because it was more than what we've recently been. So then you start looking, well, if that's going to affect us now, rather than sit back and lick your wounds and worry about what's coming next, let's be proactive about, well, let's build a more diverse economy so the next time something like that happens, it doesn't affect us as much.
Currently, U.S. crude inventories are at their highest levels in 80 years. That's one reason prices are sinking faster than the wells themselves. Controversial new drilling technologies like hydraulic fracturing or fracking have unlocked billions of barrels of black gold, previously thought to be inaccessible. While the oil industry bears most of the burden for the glut of the world's most heavily traded commodity, the beneficiaries are U.S. motorists. And anyone who drives a car is receiving a gasoline dividend that has effectively eased pain at the pump.
You know, in Texas and especially oil communities and oil states, cheap gas isn't always a good thing. Cheap gas right now is good for me when I fill up my tank, but it's not good for our community if we have to lay off people and create unemployment. So Texans aren't always happy that cheap gas is coming around.
Sweetwater, Texas, a town that may be better known as the home of the Rattlesnake Roundup, sits atop the eastern edge of the Klein Formation, a shale oil deposit that spans 1.6 million acres. In 2012, a study by the University of Texas at San Antonio projected that the Klein Shale play could bring as much as $20 billion to the region by 2022. But as prices declined, so did optimism for a modern-day oil boom. Most of the crude lies at a depth requiring advanced technologies to extract. That drives up production costs and leaves thin profit margins for producers. But Sweetwater hopes to weather the storm by diversifying its economy.
One of the things that Sweetwater's done a really good job is rather than sit back and be reactive, we've been proactive. You know, we've been given wind, and once something started, let's maximize on wind. We've been given some oil, once it started, let's maximize on it. So we've done the same thing, and a lot of the raw materials that were here, we just tried to do the best job we could to proactively maximize on the opportunities we have here.
With only barbed wire holding it back in Texas, change is in the wind. In 1998, local officials enticed developers of wind energy technology to take a chance on Sweetwater. The initial wind project started in 2000 with 100 towers, each producing 100 megawatts per year. There are over 1,300 towers providing 13,000 megawatts of electricity to the state. And that number is expected to climb to 20,000 in the next 2 years. Almost 400 miles north of Sweetwater, the town of Enid, Oklahoma, has also learned from classic booms and busts of the past. With a population of 10,000 and a geographic location capable of attracting numerous industries, Enid's financial fate no longer rests solely with the petroleum industry. Since the 1950s, Vance Air Force Base has been training fighter pilots just outside of Enid, providing a steady workforce to the town.
Vance Air Force Base has a $250 million annual impact on our economy.
Enid is enjoying investment from the private sector as well. Billions of dollars are being invested into fertilizer plants in the area for the agricultural sector.
We are a regional community, and we attract a lot of people in northwest Oklahoma. We're 100 miles from Oklahoma City, a little over 100 from Wichita, and about 110, 120 from Tulsa. So we serve a wide area, and we do a good job of that.
Even with great locations or plentiful natural materials to harness, officials in Enid, Oklahoma and Sweetwater, Texas say the best commodity any small town can have is a population that is committed to its community. But local residents still are not immune to the impact of lower oil prices.
Now, 80s was the oil bust. That was when oil was $10 a barrel. I mean, $9 a barrel. I remember those days in the 80s. And now, you know, when it was hovering around $100 a barrel for the longest time, I'm thinking, boy, remember when it was $9 a barrel and the stores were still open? So again, I think Oklahoma, they'll probably retreat a little bit. They'll reduce staffs. They won't drill as much. But if I have a pump jack or a rig on my farm, and I'm looking at that pump jack working and it was doing $100 barrel of oil, I want that thing working 24/7. But if it gets down to $40 a barrel, I'm thinking, well, maybe we should run it on weekends only. So I think we will adjust. We always have, because we know about the energy business.
Since the middle of March, the price of oil has rallied. In mid-May, crude exceeded $60 per barrel for the first time since last December. Back in Sweetwater, some residents are more optimistic about the future. Russell Petty, who owns a 3,500 head cattle operation and a printing business, says it's not a matter of if things will get better, but when.
And I've had some of the guys from the oil industry come in and talk about, you know, if they're going to actually downsize or not. And some of them are being a little bit more optimistic, and they're going to hang on and try to be in place to, you know, when things do pick up back up. And we know that eventually it will. If it's 3 months from now or 3 years from now, nobody knows, but it'll be back.
For Market to Market, I'm Josh Bittner.
Next, the Market to Market report.
Talk of El Niño's effect in the southern hemisphere and a falling dollar spooked the wheat bears this week, and subsequent short covering pushed prices sharply higher. For the week, July wheat gained 35 cents, while the nearby corn contract moved 3 cents higher. Soybeans went the other way this week as the July contract declined by 23 cents. Nearby meal followed suit with a loss of more than $10 per ton. In the softs, cotton bounced back from last week's sell-off as the July contract gained 68 cents per hundredweight. Over in the dairy parlor, May Class 3 milk futures moved 17 cents lower. In the livestock sector, prices were mixed as the June cattle contract gained just over $1. Nearby feeders advanced by 77 cents, but the June lean hog contract declined by nearly $1.50. In the currency markets, the euro moved 3 basis points higher against the U.S. dollar. Crude oil rallied again this week, finishing with a gain of 30 cents per barrel. COMEX gold advanced by $36.40 per ounce, and the Goldman Sachs Commodity Index gained 5 points to settle at 451 even. Here now to lend us her insight on these and other trends is one of our regular market analysts, Naomi Bloom. Naomi, welcome back.
Hi, thanks, Mike.
It was an exciting week in the wheat pit. For the first time in quite a while, we've seen some real energy under this market. Talk to us about where this wheat market could be headed.
Yeah, the wheat market had that nice rally on Thursday, and that was mostly in reaction to, as the show had said earlier, the short people in the market. People had just all those excess short positions. They bought their positions back. There's talk about El Nino in Australia. The concern is more that the crop there would be halved. There's no evidence of anything like that yet, but people are remembering the last time El Nino happened in Australia and the effect it did have on the wheat market then. So it was mostly just people exiting short positions, and then the market got about 15 cents higher, and then it got through some moving averages, which then triggered the next round of exiting of the short positions. We didn't see new buyers, and so the market is probably going to be running out of steam. However, we posted some really strong technical signals on charts, a nice weekly reversal, which really is probably saying that we're done going down. Now, we don't have a reason to rally from here yet. We actually would need something negative to really happen crop-wise around the world, but I think we're going to start to see the market move sideways. I'm not bullish on wheat until we see the Chicago July futures get above 525. However, I think we'll see now the market just nicely move sideways. It might be a good time for those with a little bit of a speculative nature to sell puts under the market and maybe collect some time value erosion by selling that premium.
As we just hang steady and trade choppy sideways. All right, now let's jump into the corn market. We saw a 3 cent bump this week. How much of that was attributable to spillover support from that exciting move in wheat?
I don't think there was much of a correlation between the two. The corn market had the USDA report earlier in the week. The USDA report was kind of as expected for corn. They put the old crop ending stocks at 1.85. They put new crop at 1.74. Now, the biggest joke, in my opinion, about the whole shenanigans is that they put yield at a big number. They always do. That's normal for this time of year. They kept it unchanged from the February outlook report. They've got it at like 1.668, which would be second largest ever on record. And I'm looking back historically at yield and what yield has done, and very, very rarely does it have back-to-back record yields. So because of that, and the fact that the corn market is now really down near the fall lows, it's to me looking like it's doing some bottoming signals. We had MACD technical signals that crossed over friendly this week. We don't have a reason yet to see the corn market rally, but just like wheat, I think it's done going down. And we're really in a good situation that if there's any surprises on the June planting intentions report of even smaller acres, if we have yield of 161, which is still a big number, that puts ending stocks at 1.27, which is way underpriced for corn right now, and the market would need to react and move higher because that would mean the stocks to use ratio is at 9%. So the corn market has potential this summer, but it depends on the end of June report and what the July weather is like for pollination. But so I think we're done going down.
Okay.
Yeah.
All right. Well, now let's jump into the soybean market. Speaking of going down, we had the USDA report this week. Spooked that market a little bit.
Yes.
Is there more downside ahead?
Just depends on the weather this summer. The USDA put a pretty negative picture out there for the new crop. They put the ending stocks at 500 million bushels, which is a very bearish amount. They have global stocks humongous yet again. And so the bean market between corn, beans, and wheat, the beans are the ones that are going to just be hanging over everything and keeping things suppressed. However, if the weather in August is anything hot and dry, we'll get the market to work a little higher. And then I would say in the next probably 2 or 3 weeks, that market continues to skirt near the fall lows and just trade in a sideways range. But that market, really because of how negative the fundamentals could be, could mean lower prices, but not until we know the summer weather.
So do you go ahead and make some sales at these levels, or do you hold off until we get a little bit better picture of what the fundamental crop looks like?
I think I'd hold off, but make sure that you know where your line in the sand is. If the support level breaks on charts, or if the weather is looking good, have the discipline to pull the trigger and make the cash sale, or do something with futures or options. But as long as we're trading sideways, then maybe we get some sort of a news item to let the market bounce higher, but don't become complacent.
Okay. Well, now as we move into livestock, we've got Naomi with us, so let's talk dairy. Where do you see this dairy price headed?
The market has had a nice rally over the past month and a half, actually. We saw the June contract this week get up to $17.50, but then in the same week we fell all the way apart down to $16.50. So overall, we're grinding in a nice, kind of a slow uptrend. However, our production is still humongous, 1% higher than year-ago levels. And the drought in California, we are seeing animals being culled there, and so their production is down. However, the rest of the country is able to more than make up for what's been lost. And with the dollar being down just in the past few weeks, we've seen the export market pick up. That's why we've had the market rally recently. So that's been encouraging. But again, it's the same situation where we have flush supplies, no issue there, and thank goodness the demand kicked in and the overall exports were up 33% from the previous month, but still, if you look at it from the past year, we're down 8%. But firm prices.
Okay, well now, speaking of firm prices, as we move to the live cattle contract, Thursday, we saw choice box beef hit a fresh record high in pricing, and then Friday saw a fairly sharp sell-off in the cattle market. Talk to us about where that live cattle contract could be headed.
I am really encouraged in cattle yet again because the market is able to hold on to the demand that's there. The U.S. consumer is okay with paying high price. They're like, that's fine, we're going with it. And because the dollar was down, we had exports pick up a little bit this week also. Between the live cattle market and even the feeder cattle market, the story remains the same, that the supplies, of course, are tight. Where we're at right now on charts for both live cattle, feeder cattle also, is a short-term resistance area. We don't have enough news right now to get us through there because a lot of the Memorial Day demand has already been met. However, I don't think that we see the market totally sell off. I would say more sideways trading. However, on those August feeder cattle market, I have a little bit more friendly tone to them. Seasonally, the demand kicks in where the seasonals push that market higher. The August feeder contract has resistance at 220. If it can get through there, there's some significant upside from a technical standpoint, fundamental standpoint, that it could go to 235, which would be really exciting. And I think it really has the potential to do that, but it's going to be slow because there's a lot of buyers who maybe want to be friendly, but they're very cautious because it's such a high price already.
Is this additional rainfall? We've got rain coming into the southern plains, hopefully rebuilding that subsoil moisture, greening up pastures. Do you feel that would be enough news if we get quality pasture conditions for folks to get out there and buy some more feeder calves to throw on grass?
Oh, I would totally agree with you.
Okay, so that might be one of the things that could push us over 220 and then 235.
235. It would be a pretty quick run higher.
With 155 there for your sideways move on the live cattle market?
Yes.
Okay. Now, as we move into the lean hog market, we've seen a tremendous run up as this avian flu has spread and potentially spooked that market a little higher. Have we reached the end of that, do you think?
I do. I think that we had our run. We had every reason to go higher, again, because Memorial Day demand meat was strong. Americans, surprisingly, our consumption of pork is up 11% from a year ago. So definitely those low prices spurred that demand because that's obviously a tasty product, and the demand was there. The price is cheap. The production, though, is still huge, and our overall production on pork is still up 6.8% from a year ago. And the last time we had a big production year over year like that was in 1998 when we had 10% increase, and we all know what happened to prices that year. So because the production is high, I would say this has been a wonderful opportunity. This is a pricing opportunity. We'll probably see that market set back because, again, that Memorial Day demand has been met, but I don't think that we have the reason to see it just totally fall out of bed. But the new demand is there for pork, so it's encouraging.
Would you be making some sales way out in those deferred months? Would you be looking to sell at these levels out at the end of 2015 into 2016 in the pork market?
I don't think I'd go that far out, but I would definitely go through the summer right now just because, again, of the nice, strong, quick rally that we had, which really caught a lot of people off guard. But now we got to some resistance areas on charts, and I think that we're going to see it run out of steam here for a little bit.
All right. And this avian flu, do you think is going to be an issue for a while?
We're still trying to get it figured out. We don't have our hands wrapped around it yet. Over 30 million birds lost now, and it's from Nebraska to Indiana, and it seems like there's no end in sight. It's still to be determined.
I'm going to see some uncertainty in the markets for the foreseeable future.
Yeah, I agree.
All right. Well, Naomi, thank you so much for joining us this week. That wraps up this edition of Market to Market. But Naomi and I will continue our discussion and answer some of your questions in our Market Plus segment online. We also encourage teachers, students, and anyone else who wants to learn more about the business of farming, the impact of science and technology, and even the basics of commodity trading to visit the Market to Market classroom on our website. So until next time, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company. Offering a full line of grain drying and storage equipment and steel buildings, Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.